All right, so this is a pretty huge story right here. This is a story I actually meant to get out yesterday. I recorded the video for it because as I was breaking down one of the three graphs I was explaining, I started to confuse myself. And then I subsequently spent like 2 hours doing research on the Fed and difference in the money market graph and the market for loanable funds. And, what pushes this when the recession is coming up. Does the market for loanable funds go up or down? I thought it went up, but maybe it goes down. I don't know. And then I learned more about how the Fed controls interest rates. What does it really mean when the Fed increase interest rates? I mean, obviously, I already knew that, the discount rate, they control the interest rate, and then they have like the open money market operations, blah, blah, blah. I already knew all that stuff. But what does it really mean in this story when it says, oh, the Fed raises its rates? I'll explain to you in this video. So it says Dow tumbles 876 points and stocks enter bear market on worries of drastic rate hikes. I actually don't know enough about finance. There's definitely a hole that I need to fill in terms of knowledge. But a bear market, I guess, is when there's like a good market and then it goes down with a big like 20%-ish drop, like a new one. So it's going bad right now. It says U.S. stocks have plunged into a bear market as Wall Street investors grew increasingly nervous about the prospect of even harsher medicine from the Fed to take the sting out of inflation. The Dow sank 876 points or 2.8%. The Nasdaq was down by 4.7% and has tumbled more than 10% in the past two trading sessions. The broader S&P 500 fell 3.9%. That index is now more than 20% below its all-time high set in January, putting stocks in a bear market. Recession fears mounted after Friday's miserable consumer price index report showed U.S. inflation was significantly higher than economists had expected last month. That could make the Federal Reserve's inflation control efforts more difficult. After raising rates by a half a point in May, an action the Fed hasn't taken since 2000, Chair Jerome Powell pledged more of the same until the central bank was satisfied that inflation was under control. At that point, the Fed would resume standard quarter-point hikes, he said. But after May's hotter-than-expected inflation report, Wall Street is increasingly calling for tougher action from the Fed to keep prices under control. Jeffries joined Barclays on Monday in predicting that the Federal Reserve would hike rates by 0.75 percentage point, an action the Fed hasn't taken since 1994. So honestly, it's important to really know what the hell it means when they say, what does it mean when it says the Federal Reserve would hike rates by 0.75 percentage point, right? You guys probably don't know this, but they have something called the discount window, which is where the banks can actually loan money out from the Federal Reserve themselves. But that's not what they're talking about here in terms of raising their interest rates. You're talking about a federal funds rate, which is like an overnight rate that is actually negotiated not by the Federal Reserve, but by banks themselves. So banks will negotiate with each other to get loans to cover for reserve ratio requirements. So every bank has reserve ratio requirements. If you give like a bank $100, usually they have to keep 10%, but usually they have to keep $10 of that. And the Federal Reserve themselves control that. So, if they want more money in circulation, they lower the requirement for how much you need to hold in storage. And then if they want less money, they go, okay, you have to keep more of the money back in storage because we don't want money in circulation anymore. It's making things too expensive. And so that's one of the things that they can do. And then they have like this thing where it's like interest on money that's held with the Federal Reserve on the reserve ratio. So like that $10 that they hold at the Fed, they have money in deposits in the Fed that's part of the reserve ratio requirement, and the Fed actually pays them interest, and so they can utilize that as, I believe, the floor for what the interest rate should be between the banks trading with each other. And then I think the ceiling itself is the discount window rate. They're trying to make it so that they don't pay the discount rate. They want them to pay lower between the banks themselves. So you set their discount window. Like, hey, if you want to tell Bank of America, hey, if you want to lend from me, you have to do a 7% interest rate or whatever. So that's going to make the bank one lower than 7. So the federal funds rate is actually just a target rate that they're setting. So when they say they're hiking their rates, what it means is they're setting a goal of raising the interest rate by 0.75 percentage point. And then those things that I just mentioned, they're going to use to basically influence that. And only since 2008 has the Fed started to have power to actually pay banks for keeping reserve money with them. Before that, they weren't able to pay them for that. That ended up resulting in more reserve ratios, higher reserve ratios being kept with the Federal Reserve. So banks were having more money saved. Now it appears that the inflation is actually continuing to rise even more than projected, which is actually really, really bad because it's supposed to be going down, but it's actually going up right now. So it's really, really bad. So whenever inflation is going up high, you have high prices. What you want to do is you want to employ contractionary economic policy. And so that means you want to lower the money supply and overall curb down demand. Now, what are the issues really causing inflation? There's multiple issues. I think the biggest one was I don't know if the supply chain. I just went to Target the other day and I've never seen the sports section that empty in my entire life. I was like, holy shisa, this is like, there was almost nothing. I was like, wow, I'd never seen something like that before. So it's got to be supply chain issues as well. But, what happened is, and I should have had a graph open for this, but basically the demand for goods went up as opposed to services. I believe the spending in America used to be like 50-50, where you service at restaurants, flying, hotels, blah, 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 like services as opposed to goods themselves. But because of coronavirus restricting access to those services, it increased the demand by shifting the demand curve to the right for goods. And then also what happened to the supply curve for goods? It went left, it contracted because of COVID restrictions, because you have to put restrictions in place to maintain health standards. So there's a ton more demand for goods, and then there's also at the same time a contraction of supply. That's going to give you crazy inflation because there's an increase in demand for the good and a decrease of supply. So your prices are going to skyrocket. The stimulus had a little bit of an impact, but it's pretty minimal, and it was definitely worth it for what it did. Economists are pretty clear that it saved the economy from the deflation and the recessionary possibilities that it had. They responded with low interest rates, etc. And so the economy, that's when they enacted expansionary policy, right? So you lower interest rates, you buy up treasuries or securities from banks to increase the money supply and try to stimulate investment and demand. Now you want to do the opposite, but you have those issues. Corporate price gouging is a really big issue too. There's a lot of corporate consolidation that I've been talking about for a while now, a lot. And so they're taking advantage of this issue. And so instead of looking at the businesses for price gouging, everyone's just blaming Joe Biden or government for, whatever's going on. So they're finding a really good opportunity here. And there's no real competition in the marketplace almost anywhere. And so, it allows them to do whatever they want. And because the attention is not on them, like no one believes it, they're able to just do whatever the fuck they want. So they're taking advantage of the situation. Record profits. You're not supposed to have record profits during inflationary times. The idea is that with the inflation, the cost of inputs are supposed to be subsidized by consumers paying more money to then pay for those higher inputs and labor costs. But actually, if you're making record corporate profits, what is the need for subsidization of by the consumer of your costs if you're making record profits? The idea of having the inflationary issues for a business is supposed to be, oh man, we have these costs that we have to offset, otherwise we're not going to make our numbers. But actually what we see is that they're making a ton of numbers, so it's not like they need any actual costs, right? The idea is, they're not making enough money, blah, blah, blah. That's not what's happening at all. So those are the main issues. Of course, inflation is the cost of goods going up. And so what's going to happen now, as you can see with the Dow tumbling 876 points, it's not time to panic or anything. It seems like people are predicting a recession. Recessionary definition, old one used to be 2 quarters, 6 months of negative GDP growth rates or GDP receding. But that's an old definition. Now there's a NERB is the authority on recessions. The National Economic Relations Board is a private organization. They go on a monthly basis and they take into account like 20 different things: unemployment, consumer confidence, blah, blah, blah. So I don't even know how they really determine it now with so many variables. But I think they said in the beginning of Corona, there was 1 month of a recession, and then we got out of it after, we stimulated the economy, right? We stimulated it, right? Lowering interest rates and increasing the money supply, etc. Another thing I guess we're seeing is that money is, the USD is actually getting stronger too, because as interest rate goes up, and I'll explain this to you by demonstrating the graph, as interest rate starts to go up, foreign investors are more interested in putting their money in your banks because you have higher interest rates. So they want your currency instead of theirs. So that boosts up the value of the dollar. So this is not something that's like a big, it's going to collapse. This is actually something that's necessary because the economy is overstimulated. It's overstimulated, but also the issue is the supply chain is a really big issue. So it's like you can tackle this through demand or supply. I still think it's more of a supply issue than it is a demand issue. But once the economy is overstimulated, you're supposed to retract the demand curve to get back to normal, so you can bring down prices. Really, in this situation, you could either taper down demand, you could shift the demand curve left, or you could shift the supply curve right. I think we need to focus more on the supply curve going right. I think that's a better way to look at it. I should have had a graph on that, honestly, because probably don't know what I'm talking about. But there are some graphs that I have here. This one is the exchange rate graph. I can start out with this one, I guess. This is a pretty simple one. You have your exchange rate up on top on the y-axis, quantity of USD on the x-axis, supply demand curves for whatever currency we're going to look for. We're going to use USD here. And so what ends up happening as investors, once you see that the interest rate goes up and the investors are like, oh, wow, this is going to be like give me a good returns on my savings. And so the demand for USD is going to rise. And so what you can see here, this is called the equilibrium point. Understanding equilibrium points is extremely important. Basically, the equilibrium point is where the two lines intersect, the supply and demand curve intersect. That's where both supply and demand meet each other, so there's no shortage or surplus. So you can see if you want to compare the equilibrium points from the original S&D to the S and the, we're going to call it DUSD1 is what we're going to call it. And so what you can see here, this is the exchange rate, right? So this is our first exchange rate, and then this is our exchange rate 1. So what you can see is the exchange rate went up. So USD is now worth more because there's higher demand for USD. And then for the other foreign currencies, they're going to go down, right? So the USD is going to become, it's going to kind of become bolstered. There's actually two separate graphs when it comes to talking about money in the economy. There's one talking about the money market graph. This is actually the cash that's within the economy, direct cash. On the y-axis, we have nominal interest rate, not real interest rate, but nominal interest rate. This is really important. And so what you can see is that the demand for cash is actually, it's really high at high interest rates, right? So, you have a very low demand for money right here. You can see the quantity of money is like close to zero right here. Let's say it's like a 20 interest rate, right? Say it's like a 20 interest rate. You have like a, tiny amount, like 5 billion or whatever, demanded at a point of 20% interest rate because people want to keep their money in the bank because it makes them more money, right? But here where you have interest rate at, let's say, like, 5 or whatever, maybe people want a lot more dollars. They want much more money. Maybe they want 600 billion instead because, hey, that money's not going to make me money. I want to keep cash. And so the money supply curve is actually it's straight up. It's just completely straight up. And so what the Fed actually does is, this is another thing I learned, they actually don't set the interest rate itself. I mean, they can through the discount rate and the things that I explained to you earlier with the federal funds rate. But one of the ways that they do this is they affect the quantity of money that's in circulation by using open market operations. So when the government or when the Federal Reserve purchases treasury securities, they give cash to banks to then go lend out. That stimulates the economy by increasing the money supply. When they sell, it means that they're going to give the asset in exchange for dollars, taking money away. It's the reverse for bonds because the bonds are a reverse of loans. A bond is giving an IOU, giving out a loan is you owe me. So they're opposites of each other. So, you would sell a bond. Selling a bond would be the one that would end up, contracting increasing the economy. And so, that's what you can see here. So what they do is, like, let's say they decide, the Fed sets it so it's all a straight line. And so let's say it goes over here to like 400 billion. Now you have a different interest rate because here you see this is where it intersects. Remember, this is your equilibrium point. Always remember that term, equilibrium point. You must know equilibrium point if you want to understand economics. So you can see that the interest rate went down by changing the amount of money that's in there. So this is one of the main things that the Federal Reserve is going to do. They're going to start to sell off securities in order to, they're going to start to do that in order to decrease the money supply so that there's less money in the market. They want to have a higher interest rate, so they're going to want to move the money supply back. they're going to want to get here to, whatever, 10 billion. These numbers are completely off, by the way. But, let's say it's like MS2, it's like MS1. Look at where it intersects now, like a 15 or whatever interest rate. And there's only this much money. So whenever you have like 10 billion, it's going to be way less than if you have 300 billion. The interest rate, if there's $300 billion worth of money in the supply of money, you're going to have a much lower interest rate. So they want to raise interest rates right now because interest rates, as you guys hopefully know, it's a very basic and important thing to know. Low interest rates makes borrowing cheaper. It incentivizes people to invest their money instead of saving their money in their bank account. So this is another one. It's called the market for loanable funds graph. Okay, so this one used the real interest rate on the y-axis. This was the graph that actually got me confused and caused me to end up taking like 2 hours to do reading on it. Still not entirely clear, honestly. But use the real interest rate. Real interest rate takes into account expected inflation, whereas nominal interest rate is just a nominal supposed number. And then on the x-axis, you have quantity of loanable funds. We have our supply curve, supply for loanable funds, demand for loanable funds. Now, what I had thought essentially was the supply for loanable funds should really go right. It should really go to the right just because more people are saving their money because they're expecting a recession and higher interest rates. So more people are going to save money. There should be more money for supply of loanable funds. But I guess it might be the case that it actually contracts because of the fact that banks are actually banks are currently they're buying up. They're buying securities, from the government. The government's buying up their securities, and so there's less money to use for investment because banks don't have as much money. That's where you put your money, right? So your money is deposited, but, the government, the banks are instead buying investments instead of having government buy investments from them, which then they can loan out the money. So this might be it, and so you can see the quantity of loanable funds goes left here. And the demand for loanable funds should also really, really tank here because nobody wants to invest in a shitty economy. So this is going to make the quantity of loanable funds go even more. So remember, like I said, guys, make sure please to understand the equilibrium points. You need to understand that. This is our EQ. We're going to say EQ here. We're going to say EQ1. And let's see here. We're going to say EQ2. So you got this is the curve between DLF1 and SLF1, supply of loanable funds 1, demand of loanable funds 1. So this should be how far away like your quantity of loanable funds is going. There should be less money in circulation for loans because less people want to invest, and also banks are purchasing. They're purchasing loans instead of selling them to the government, which then gives them hard cash that they can develop. Now this, honestly, I'm not 100% sure if it's 100% on the money. I mean, if this is wrong, definitely let me know. But hopefully that one is right because I don't know. The thing is, like, understanding the difference between like how does interest rate hike by the Fed impact the market for loanable funds. I'm not entirely sure. I would think it would have to make it, make the supply of loanable funds shift right, because I thought more people want to save, but I guess it's not because banks are purchasing securities instead of selling them to the Federal Reserve, so they have less cash on hand. So I guess this makes the most sense in terms of the quantity of loanable funds should tank. Because there should be less money in circulation for loans because no one wants to take out loans for anything. People want to save their money because there's a higher interest rate, right? So what you're going to see is a recession going down here. The economy, I don't know if it'll officially go into recession, but stocks, crypto is going to tank because the economy is overstimulated. But again, I think a lot of this is really an issue of supply more than demand, but there was a lot of cheap, borrowing for a while that we saw. So that's obviously going to lead to overstimulation in the economy. It needs to be tapered down. But I really do believe that a lot of the economy's issues are supply related. And so, you don't necessarily want to respond to supply issues with demand issues. And that's why it's so important to understand economics and, even like inflationary issues with wage raises. The problem with raising wages is that if you raise wages in response to inflation, you just make inflation even higher. So because when you give more, one of the things that's a determinant of demand is income, right? So your demand increases, it shifts to the right when people have more money, especially those people, as they have a high ass marginal propensity to consume, right? You give like a rich person more money, they're probably not going to spend it, so it's not really a high marginal propensity to consume there, whereas like poor middle class people have a much higher marginal propensity to consume. So It's going to shift the curve right and demand curve right. Anytime you shift the demand curve right without moving the supply curve also right, you're going to have a massive price hike. So what you want to do is you want to bring the prices down for the consumer, not give them more money to pay for those higher prices, because those higher prices are going to become even higher. And then you have to give them even more money to cover for that inflation. And then you have to keep doing that. So it's like, if there's a difference between tying the minimum wage to inflation under regular circumstances when inflation is small, that's fine, right? Like in like $15 minimum wage legislation, like, okay, we need to tether it to inflation, which the bill did have. That's good. But in the current like extreme inflation that we're seeing, it really does not make sense to raise wages, because once you do that, then there's going to be more inflation and then you're going to have to pay more. And it's just like, it's never going to work. So instead of looking at raising the wages, you need to bring the cost down instead of goods. A lot of that is going to be, corporate consolidation and really corporate price gouging you got to get over and stop, and then all this other stuff. But responding to that with wage raises is not the right thing to do either, just because it's just going to make the prices even worse. But it's going to be super interesting to see, man, because I mean, a recession, you worry about unemployment issues, right? The dangers of recessions really are resulting in depressions. Like a great recession is really bad. Like the 2008 recession was horrible. But like a normal, regular recession is just natural. It's just what's needed. Like I said, we overstimulated the economy. You have to destimulate it. You have to taper it down. And so what we can see here is that there's the interesting thing about this is going to be there's so many different economic things going on right now. Like anywhere you go, everything has a now hiring sign. So there's clearly a labor shortage. So it's hard to imagine unemployment issues resulting as a result of this recession that's upcoming, because it's like, look at how much of a labor shortage there is right now. In a recession, there's not enough employment opportunities for people. Right now, people are turning down employment opportunities. Right now, people have left the labor force entirely. They said, F that, I'm outie. So they're not even in the labor force right now, a bunch of them. So how much is the recession going to impact unemployment, which is one of the biggest concerns? It's probably, I mean, it's kind of one of the two biggest concerns. I mean, the issues with recessions, right? And the Great Depression could have been avoided if the Federal Reserve had stepped in as a lender of last resort for banks, and gave them money when bank runs were happening and acted as a lender of last resort. Which is what what they do now. That's what they did during the 2008 crisis. If the Fed hadn't stepped in 2008, we would have had a Great Depression, because the entire economic system would have collapsed. And what would have happened is everyone would have taken their money out of banks. There'd be no money to invest into businesses. No businesses would be able to get any loans for anything. No one to invest at all. No one would even have money in banks. And so everyone would have money in their couches and their beds. And businesses shut down. There's no opportunities for business expansion, and unemployment results. People are out of work, and then government has to step in, and they have to spend a lot of money too. So you have to prevent deflation, like that kind of deflation of like technology has allowed a certain item to be made cheaper, so ergo the price is cheaper because of input goods being cheaper. That's good deflation. But deflation where it's like everything just gets cheaper because there's a recession, that's bad. That's not good deflation. So you have to prevent that deflation. But it's like, are we going to see that kind of recessionary unemployment issues when you have this kind of thing of like there's so much labor shortage? I don't know, man. I mean, it's fascinating shit from an economic perspective to see all the different shit that's going on, all the different potential causes of inflation. I mean, there were a lot of potential causes of inflation in the 70s and 80s as well, about the Phillips curve ended up getting proven wrong. Phillips curve says that, there's an inverse relationship between inflation and unemployment. They're the reverse of each other. There's an inverse relationship. You have like 8% inflation, you can have 1% unemployment. If you have 1% inflation, you can have 8% unemployment, but you have to choose one or the other. That got debunked, during the stagflation days. Stagflation is when you have economic recession plus high unemployment plus high inflation. You're not supposed to have all three at once. That's never supposed to happen, because in that theory, right, they're inverses of each other. So you're supposed to have high unemployment, but inflation is supposed to be really low. But that didn't happen because a lot of supply cost pressures because of oil shocks. So a lot of crazy shit happening right now. The stocks are going to tank. Crypto also is interesting, because I was looking at I thought crypto was supposed to be like a hedge against inflation, but I mean, they're tumbling with inflation going up. They're tumbling like crazy. So I guess it kind of loses reputation, even, I don't know, of being this kind of like hedge or bet against inflation in the USD. I thought they had like an inverse relationship to each other, where it's like, oh, when when the USD goes down, the Bitcoin goes up because they're separate currencies, and so they should, inverse. But I guess that was wrong because I guess it's viewed as an investment as everything else, instead of just being like a currency. So, a lot of fascinating stuff going on here. I know I just threw a ton of stuff at you. Comment down below. Jeezy, if you're still here at the end of the video. Anyways, thanks for watching. Crazy stuff coming.